Dissolving an S corporation with outstanding debt is a complex process that requires careful planning and legal compliance. Business owners facing this situation need to understand both their obligations and options. When a company dissolves or liquidates, it permanently ends both legally and practically. However, the debts don't simply disappear. A dissolving corporation may owe bank loans, payments to suppliers, final tax obligations, lease commitments, and other financial obligations that must be addressed. There are three primary methods for dissolving an S-corp with debt. The first is voluntary liquidation, where the company sells assets to pay creditors before closing. The second is administrative dissolution, typically used when a company has minimal assets but still needs to resolve debts. The third option is bankruptcy, which provides a structured process for companies unable to meet their obligations. For corporations able to pay their debts, the dissolution process involves several critical steps. These include ceasing all business operations, repaying any director loans, settling all debts, maintaining the company bank account until all payments clear, handling company vehicles, running final payroll, preparing final accounts, paying last corporate taxes, and distributing any remaining capital to shareholders. Most states require filing articles of dissolution with the Secretary of State. The IRS requires filing Form 966 for corporate dissolution or liquidation, along with a final tax return. Many states also mandate tax clearance before approving dissolution. Failing to meet these obligations can result in legal complications and personal liability. During dissolution, business assets play a crucial role in settling obligations. The process typically follows a specific order: selling off company assets, paying secured creditors first, settling unsecured debts, and finally, distributing any remaining assets to shareholders. If a company lacks sufficient assets to cover all debts, creditors may negotiate settlements or write off bad debt. S-corp directors are generally protected from personal liability for corporate debts thanks to the corporate structure. However, this protection has important exceptions. Directors who signed personal guarantees on loans or leases, engaged in fraudulent activities, or failed to properly withhold and pay payroll taxes may face personal liability. To minimize risk, directors should maintain proper financial records, comply with all dissolution requirements, and seek legal counsel for any disputes. Unpaid taxes require special attention during dissolution. The IRS and state tax agencies require final tax filings, and unpaid taxes can prevent dissolution approval. Directors may be personally liable for certain tax obligations, particularly payroll taxes. If an S corporation cannot pay its debts through normal dissolution, bankruptcy becomes an option. Chapter 7. Bankruptcy provides for liquidation, while Chapter 11 allows for restructuring. Both provide a court-supervised process for addressing creditor claims. Dissolving an S corporation with debt requires careful navigation of legal, financial, and tax obligations. While not legally required, professional guidance from attorneys and accountants can help ensure compliance with all requirements and minimize potential liabilities for business owners and directors.